All right, everybody. Hello and welcome. You are here for the June 2026 Jobs Report and Inflation Update. My name is Albert, founder of Albert's List. We're a job search side hustle and AI education company. And every now and again, with everything that's going on in the market today, you not only want to get to know what's going on in your job search, you also want to get to know what's going on in the market. And so for that, we have Dr. Reilly White, who is chair of the Finance and Innovation Department, professor of finance, and Douglas M. Brown Endowed Professor of the James and Gail Ellis School of Business Leadership at the
Yeah.
University of New Mexico. Say that
We
10
got
times fast.
renamed.
Say
We
that
got
10
a
times fast, right?
we got renamed. We had a $30 million gift. So if any of you guys want to pool your money for 31 million, we will name it after you. Maybe.
The
I gotta read
Alberts
this.
List School of Business Leadership at the University of New
There
Mexico.
are stranger things, Albert. The Albert's List School of Business Leadership.
I love it. And if you're wondering who Dr. White is, he is all those things. He's also the director of the $6 million student-run University of New Mexico Regents portfolio, leads a series of financial literacy projects in the community, and has also been written up in many different journals, including Physica A, the Journal of Corporate Finance, IEEE, the Journal of Banking and Finance, and much, much more. So he is qualified. He has a doctorate in economics. We'll share his LinkedIn profile here shortly. And he's here to just share with us all the data and also answer the many questions that you have as you look out from your home offices and the traffic into the void as you wonder where the heck is everything going and what the heck is happening. So Dr. White is back again this month to share with us some more information and news and views that you can use in your job search. So feel free to use the question and answer function. This webinar is being recorded, and we're going to send you the recording later as well. Yeah, we can go from there. Dr. White, it's good to have you back. Tell us what the heck is going on.
It's been a month, everybody. How's everybody doing? If it's your first time here, I'm so sorry. It's great to spend an evening with you at 5 p.m. on a magnificent Wednesday. For those of you who have returned, the people, the gluttons for punishment types, we've got the Melanies, we've got the Aarons, we've got the Elises, and et al. Thank you so much for coming
Well, the
back.
economic shakedown will continue until morale improves.
As it will continue. Got the Charles twins here. Got double Charles. So this is great. So we're going to go through a whole bunch of stuff today. And as always, it's an honor to be here and talk to you all. And if you've got any questions, plop them in the chat and then we will engage them. So today, let's take a look at our June jobs report and inflation cotillion. Thusly named, we're going to talk about a large number of different stuff that we'll go over today. We're going to talk about I had a bunch of interesting questions about the tech. When a tech job is going to change, what do they look like? I've got some more nuanced data to play with on there. And we're going to actually go into some more details about some of the other stuff. Aaron sent me a couple of links, and I gave Aaron props on one slide, particularly Aaron. So heads up on that. Glad you're here. And let's take it away from here. Okay, let's talk about the overall feature. When we think about jobs report, one of the big headline number that we use comes from the Bureau of Labor Statistics. It's based off of a very, very important survey of how people are doing, how the job market is doing overall. This was incredibly disappointing, and I say that as somebody who knows disappointing, just as the nature of my work and for the rest of let me tell you, I know disappointing, and I'm it. 57,000 jobs were added in June. Not only is that just absolutely tepid as job market reports go, they're also, this is so bizarre, this jobs report. We've got 36,000 in professional services. That hasn't been on the top deck for a while. 25,000 in social assistant jobs. Surprisingly, the number one loser in this market was leisure and hospitality. Despite the World Cup being hosted in the United States, analysts believe that the World Cup added about 40,000 to our overall figures. Goat would improve most stand-ups. Professional services number was a nice change for once. It is, Albert, you're absolutely right. This professional services number is something I wasn't expecting, nor do I have a valid explanation for it. We estimate there's about 40,000 jobs overall that are supported by the fact the United States is holding the World Cup here. But strangely enough, our leisure and hospitality sector is weaker. There are thoughts about this, about it's preliminary to note that it could be based on disappointing discretionary consumer discretionary numbers. It's too early to tell if this is a blip or this is something more meaningful. Melanie says, did everybody hired for the World Cup in June stow away with Holland's raccoon? I'm glad he brought that home with him. it's very important that people come here and take our taxidermy elsewhere. It's I consider that a true American export. Colin says, is leisure hospitality going down a canary signal? Maybe people have less disposable income. 1 month is tough, and I think, Colin, that's exactly what people are leaning towards. If we see one or two more of this, less disposable income, less consumer spending, less spending on stuff like restaurants and hotels, especially for domestic vacations, which is where most Americans travel in summer. This could be part of it, but it's not. It's very noisy in this data. This is really interesting. And this is also, there's a couple other pieces to this that are really important. Household surveys, the other survey data that came out showed a drop in participation of about 720,000. And employment overall dropped 507,000. That means that participation in the market, people who participate in labor force, they have a job or they're looking for a job. And we've seen more people drop out this month. And some of these numbers that were just released on this are extraordinary for how many people are dropping out of the labor force. And labor force participation dropped to 61.5%. This is the lowest we've had in a very long time. Employment to population ratio dropped to 59%. These numbers, minus 0.3%, minus 0.2%, is a lot for a month. And strange, given especially summer tourist seasons and other things where we typically see across many tourist cities in the United States at all, we see more people in the labor market than before. Now, this could also be explained by, is there more people? You could look at this and say, well, in summer in cyclical economies, and I'm using an example here. I live in Santa Fe, New Mexico. It's very cyclical on a seasonal basis. Unemployment rises, in fact, in summer, despite there being more workers because it's tourist season. And as a consequence, there's also more people looking for jobs. But we're actually seeing the opposite happening nationally, which is a fascinating question. And therefore, because so many people dropped out of the labor force, unemployment dropped to 4.2%. Now, I'm going to get into this question a little bit because I was interested in this. And we're going to delve into a few of this. I heard some weird takes about this in the Twitter sphere recently, and I kind of want to address whether they're false or not. Charles points out the new administration is still learning out how to fudge the numbers. Mistakes will be made. This is a very strange. If this is fudge, it's very strange. I mean, like, at least headline number it in some other way. It could be a learning curve. Lawrence says, good point with this administration. How can we trust these numbers? Now, this is an interesting question. And so I see this often. I just gave a talk for our Rotary organization, among other things, just last week, and this question came up about the trustworthiness of the numbers that we have. Now, it is very hard, and I want to reiterate this. Corruption is not something that happens overnight. You don't wake up one morning and say, goodness, there's, your boss comes in, you get new management, and somebody says, come over here and cook the books with me. And you all devise new numbers. It's a very gradual, process. It requires acclimatization or something. You arrive at a organization, suddenly you're asked to do something that's a little iffy. Then, you might be involved on a couple other things. Then you're holding, and before long, over a while, you're holding the pen that's actually fudging the numbers. And in this case, it's the same way with anywhere else. And this is the hard part that economists everywhere are struggling with this question because it seems weird. I mean, the numbers in aggregate are probably, I mean, 57,000 is probably where I would think the job market is based on the other numbers and other labor data that we've seen so far. I don't see any proof that the numbers are being cooked, so to speak. I do know that the administration, as we focused on last time, has a history of not cooking the numbers, but and particularly bad in this administration, but they're not the first ones to do it. They're selective about what numbers they use and qualify. Oh, we're lowering prices because egg prices dropped, when in fact, fuel prices helped, and tariff costs ended up rising, like 83% of all of the categories of prices that we've seen in the last year across the country. So this is a really, really big question. So we don't see evidence enough of this yet. And so your cynicism's well placed. And I want to say that always be cynical about anybody, me, anyone else, giving you any type of information or numbers. But as Albert points out, if the admin wanted to cook the numbers, who all would need to be in cahoots? It's like BLS Fed banks around the country, employment offices in all 50 states. We can't keep that kind of a secret well in aggregate. But to the point of this, it's also the integrity of the economists behind it. There is some things open to interpretation. If we look at things like, working in the college sphere and being in administration for a number of years and being involved as associate dean and rankings and other things and doing everything else, there are mechanisms by which people can be dishonest. And so this case for BLS numbers, the history of the collection process, the surveys, all of this stuff, very, very hard to individually select and kind of cook this way. But I'm not saying it's impossible, but it's going to take a long time. And so like 3 years from now, who knows? But that's a big issue. Aaron says job participation rates falling. Huge amount of people don't want to do lower service jobs, losing millions to immigrants. There's a massive shift in trade related jobs, transportation, logistics, value added services. At interest rate related jobs, boom goes the dynamite. That's also a very absolutely true story. So we're going to talk about this first, and we'll get a little bit in more with tech for a second. So YCC Capital runs this job vacancy index and the Indeed job posting index that kind of levels out at 100 back in February of 2020, the last month of our truly pre-COVID times, the before times. We were innocent and young, and all we had to worry about were whatever it was we worried about in those days. Certainly not diabolical illness. But what happened in the last 6 years is that we saw that post-COVID bump in terms of that trillions of dollars of added stimulus spending coming back in the form of added jobs that made up for the jobs that we lost during the COVID pandemic. And then it's leveled off, and it's also been going relatively downhill for relatively speaking for the last year or two, at a much shallower rate than it was before. But we did see a little bump in the vacancy index to suggest that maybe hiring might be around the corner. But there's some caveats to this. Let's look at tech for a second. And I got into the DICE report a little bit that they just released last couple weeks ago. And it's a very interesting report about tech jobs in general. And so there's a couple narratives at play here, and I want to go in with them. So the first is, and we sort of saw this in the numbers in March and April, and it wasn't enough to dictate it, but there was definitely a trend setting. One of the questions I have is, when will tech jobs turn around? When are we going to get California to bring back tech jobs? Two interesting questions, two separate answers. Now, tech jobs in general are doing better than they were. February through June specifically, we've seen kind of an added bump in new job postings. That's been pretty good. As Aaron's out, New Jersey's rocking. They're cooking. Jersey in the house tonight. Thank you, Aaron, for coming. And if we look at the AI related machine learning jobs in particular, we see a lot of this growth is what we're driving this. You look at percent of tech jobs are AI ML, and we see this percentage go from 10% back in June 23, and now some of these postings, about 80% are AI and machine generated. And then the top 10 states with tech postings, unsurprisingly, California and Texas are up there. Single biggest metro area, the New York, New Jersey area, about 20,000, followed by DC, almost 20,000 job postings as well. If we add up San Francisco and San Jose and put them in a nice bucket, we arrive at about 16,000, making it the third biggest. Per capita, they have the most. I got to divide the numbers by the populations, but they perform very well. Dallas is up there, and even LA showing surprising numbers of workers coming in. Interestingly enough, Albert, this is aggregate numbers. So even places like Phoenix, Seattle, and Salt Lake City, they're just not producing the same type of numbers that we're seeing in these areas. And year to year change among the top 10 hiring states, we do see things like New Jersey, year on year change in hiring, 64%. This is the Aaron effect. Thousands of biotech, as Aaron points out. Aaron comes to town, he increases hiring. Maryland, Illinois, New York, Texas, California, not too shabby, 21% year on year. That sounds like a lot. Run. And then Virginia, Florida, North Carolina. Okay, so you're looking at this, and there's some skepticism. Why am I not feeling it here? What's going on here? As Melanie says, what's going on there? In Maryland, what's happening in Maryland? Who cares about Maryland? And so despite this very tech-centric and let's be close to the government center of tech jobs, which is a valid concern, tech jobs are widely said, not just tech companies themselves, but of course, tech-related stuff at companies. And if you're close to the power centers or the imperial capital that we have in Washington, you get a lot of attention. You get a lot of interest in a lot of these areas. And Albert's surprised Florida's not higher since every billionaire tech CEO seems to be opening up an office in LaSalle and buying a home in Miami. Glass fiddlesticks. Homes in Miami, not what they used to be. Miami's interesting. They actually showed their population growth has leveled off significantly in the last 2 years. Very, very sexy place in finance, like in 2022, but then it burned out really quickly. So the top 10 fastest growing skills are your qualifications. So follow-up question that we had is, what do we reskill for? This is what people are hiring, and why aren't my skills the same? And we'll go into this. I got some other data too. We're going to go into the California problem coming up in a second. But the 15 fastest growing skills or 10 fastest growing skills and qualifications, enterprise integration. What kind of, you're looking at this, you're a software engineer and you're smoking your 18th cigarette in the last 10 minutes and you're saying, my God, what does that even mean, enterprise integration? Who are these people? Is this a businessman in a suit trying to tell me what to do? And then you have, you have AI agents, agentic AI, responsible AI, artificial intelligence infrastructure, irresponsible AI, also up. Vector databases, event-driven programming, database software, retrieval augmented generation, the RAG. And then you've got next on the fastest growing skills and qualifications month on month. We saw in the last month in exploding in electronic engineering, go figure that one out. API system integration, digital forensics, data exchange, threat detection. So cybersecurity is interesting. Back in April, I attended a cybersecurity conference in Pittsburgh, Pennsylvania, obviously known for its cybersecurity. It was pretty good, actually. It was decent. But we were telling me they had representatives from the government saying, oh, cybersecurity is very important. We need cybersecurity. And everyone asked them the same question. Is there money? Is there jobs? You know, if you're an academic institution, you want to build cybersecurity up, you need to invest heavily in the tech required to make that happen. And the government's like, no, we don't have that for you. But we have, we just want your people. So it's a very interesting question. Anyway, Albert says, I saw that for every 10 people who move there, 9 leave. And it's that service workers leaving. It felt a lot like San Francisco. That is fascinating. It feels that way too. That was my vibe too last time I was there in March. Lauren says, has to be extremely expensive for basic service workers to live here in the Bay Area. And that is part of the dilemma that we're going to see next in the next chapter. Bam, you are getting on it. Melanie says, enterprise integration sounds like the e-commerce of 2001. Management consulting all over again. It's coming back, everybody. Oh, yes, I'm an enterprise integrator. Keith says, the hack ETF has been going way up. That's a good one. We'll talk investments too in a sec too. And hack ETF, as you noted as well, that's the type of companies they're buying, and that's what's in this little package. And exchange-traded funds, of course, unlike mutual funds, are kind of usually a relatively fixed basket of stocks and securities that allow you to buy into an entire sector or subsector of stuff that you're interested in. And the companies operating in the space have a fun little hack ETF. So money is going. Lawrence, thank you. Larry Staley. So then I got into the CompTIA tech jobs report, and this is more nuanced now. So you looked at this, and you're like, wait a second. It feels like I'm gaslighting you. It says, look, tech jobs are actually better than they were there before. And look, it's great, guys. Everything is great. Look at this. And by the way, enterprise integration is up 638% because we found a keyword that said enterprise integration. I think what happened is this has to be like like something that to increase 7-fold or 6-fold over the course of a year. It has to be, that's like an AI effect and create a job for me that I need based upon these parameters. And they're like, you need enterprise integration. Oh, let's put that in the job. Somebody will do that. We're finding that interestingly in citations for academia. Tech jobs report, tech job postings. So number one, let's look at the top states for tech job postings. I know this is tough to read for those people in the cheap seats. You're operating a tiny little screen. You're watching this on your watch or something, and you're on the BART, and you know I'm shouting. You have the sound on or something, and you're just letting me drone out the noise of the train tracks as you go to Oakland. So the top states for tech job postings right now: California is still number one, 30,000, but we are still annually 587 jobs behind this time last year. Texas leveled off, 41 more jobs than they had last year for postings. Virginia, New York, Illinois coming out there. The DC space still driving a lot of that area. Now, the top states for tech postings change. Where are people going? New York, number one. DC, Washington State, back to Albert's thing. A little bit more nuanced. Here we see like a 10% increase over where we were last year versus April, actually, not just a year ago. I'm sorry. This is the change versus April, not May, not annual percentage rate, which is what my mind automatically went to. It's there between May and April. My bad. Whoops. So in the last month, we're down a little bit in California jobs, up a lot in New York and DC jobs. Top metros for tech job postings. It's New York, DC, Dallas, Chicago. San Francisco is still up there. If we add San Francisco and San Jose together, comparable figures to our other source, right? So we're up about 16,000 jobs in total, about DC sized in terms of the number of jobs available. But note that both San Francisco and San Jose, regarding even their April job postings versus May, they're down 688 in San Francisco, 737 in San Jose. So the weakness you feel is present, especially in the Bay Area. You see this high push in other areas. Chicago, notably, also down 1,000. A high push in other areas, things like New York, things like in general Florida, to a certain extent, up 400. Back on the other reasons, Arizona. But you don't see it. You see this trailing off in other places. And if we look at the top metros for percentage change, just by job postings change, LA comes up with a 787 change versus May. Month on month is really noisy. There's a lot of things there. And also to Albert's point too, Virginia numbers gaudy. My guess is despite all the hemming and hewing about cuts, the U.S. government's hiring a lot of people for the AI build out. You're absolutely right. I think the government infrastructure, it's a drop in the bucket with Elon's cuts and whatever. That's a drop in the bucket to government expenses. We'll talk a little bit about that at the end in terms of there's a cool tool where you can adjust the national debt that Aaron sent me that I'll show everybody. But Agentic API enterprise integration is fundamental to building the new enterprise architecture in the Fortune 5,000. Cooking in the New York metro area. Bam, bam, biopharma, financial, logistics, transport. You heard it here. Rock and roll it. And then you look at tech industry employment as a whole. And this is a chart that goes from May 2024 to May 2026. You see that in millions, it is trending downward. And that's interesting. So despite the fact there are more postings, those numbers aren't showing up in the aggregate numbers of hires. And the unemployment rate among tech occupations in general, well, historically very low. It was just 2% in late 2024, is now closer to 4%. It's still trailing the national unemployment rate. It's still better to be in tech than the average job in America today. But in general, you are seeing a weakening of that market still. That is a really, really big issue. Let me see for a second before we switch ideas. I want to step back for a second, and I want to make sure I addressed that question because I had a couple others too. And one question was really interesting that you asked before this started, and it was concerning California specifically. And the question asked basically, what can we do to improve the I want to get the actual verbiage here. To improve the situation in California, to improve the market in California, to improve tech hiring in California. So there's reasons, of course, that tech companies in general, while being the deepest, having the deepest resources in the Bay Area for startup capital, for enterprise building, for just the wealth of talent there is just immense. When I send my best students out there, they go to the Bay Area, they want to, especially international students. I just had one of my co-author students on a paper we're trying to get published right now. He's out. He went out to the Bay Area to intern over the summer and ended up taking a job in Seattle, incidentally, but for a large tech firm. And that's all great. But California itself has an infrastructure problem. It has a real estate cost problem. It has a generalized cost problem. It has a building problem. And this sounds strange, especially if you compare it to where there are jobs in places like New York and New Jersey and Connecticut and Massachusetts or even Virginia. Those are also expensive areas of the country, but they're comparatively cheaper to build in. Part of the thing is cost of living, part of the thing is structure, part of it is the mechanisms of power. Right now, cyclically speaking, we have, for better or for worse, a government that is more centralized and a strong executive in places that we've seen in some time. And to curry favor with this organization, to curry favor with these firms, companies are making strategic hiring decisions in places where the power sits. And that's a rational decision one makes in a centralized bureaucratic regime. So I think that's some of it. But what can California do? Give me some stuff. Make building easier. Go about the work. Really be aggressive about it. Stop. Take business formation seriously. And you do it already with this, but think about other ways you can make it easier. Everything from permitting to licensing to developing frameworks for companies to stay and keep and platform. And it's going to be decades long, or else you'll continue to bleed people like this. And there's a lot of good ideas out there. Whoops, let me kind of switch this around for a second. So I'm having a hard time getting my notes on this. I loaded up on my email and I was like, "Oh, come on, do it, do it." And it may not show up, but maybe I'll step away from it and it'll work as soon as I leave. But da, 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 da. Let's switch. Let's go back and let's just fiddle with it because that's going to take a while. All right, so sharing the slides. All right, next on the docket. I had a question though about because that's a big question. What can California do better to get tech jobs? It has to be a better long-term friendly environment for things. It is still going to be, it still has all the infrastructure. It does a great job of doing it, but they risk entering a position where they might cultivate or develop companies and end up leaving, which is like a New Mexico problem in some ways. And you don't want to be like New Mexico that way. Legal professionals. I had a question about lawyers this time around. So I think whomever sent me this question, and this is the first legal question I had in some time. So I had to dig deep. I looked at a Robert Half report. I did some other things, looking at other things, trying to figure it out. They said, what is the market like for experienced lawyers? What is it like for the experienced litigator out there? And so where do we see shortages in the legal market? So let's say you're thinking about law school, you're interested in law school. What does it look like? And as you might expect, corporate legal departments are saying, they want to hire in data privacy and cybersecurity, regulatory compliance, risk mitigation, as well as legal operations and efficiency. Law firms, on the other hand, have the biggest holes in regulatory compliance and risk management, which is very similar to risk mitigation, risk management, two birds, same thing, same type. Litigation growth and specialization in AI governance. And so, what an interesting place. If you're thinking about this on this side, you're weighing this, if say you're a lawyer right now, and lawyers' legal expertise can be something that's very nuanced. And I was speaking to a lawyer friend about this, and she's got years of experience working in a very specific type of water contract law, which is a very New Mexico thing to grapple with. And it's a very hard market to enter. It's a very hard market because there's only a certain number of firms who operate in this space, and it's so nuanced in this space that they have a difficult time finding jobs outside of this in places that might be different than this, or smaller towns or places out of say the desert or other cities where this sort of water related issues become important. And so then what does the upskilling look like and what does the reskilling look like? And it's hard when you spend your career operating in a space where there are cases in specific instances that you've been doing day in, day out, that's what develops your expertise in this. And there are certainly adjacent like regulatory areas where you could embark upon because you've touched upon them before and kind of look to these areas first as places where you can develop a skill set that's parallel to the one that you have. But then there's also this other overarching thing, and people look at things like AI in general because all of these, it just bleeds AI, cybersecurity, and the digital space. And if you're in this and you're looking at this and saying, is this a fad? Is this going to crash? Is this going to go away tomorrow? I mean, and this is, it sounds like a naive thing to say, but I think personal mythos and personal philosophies are very strong things to develop. You can find yourself researching a topic that ends up being an absolute dead end in the long run. You'll still learn something out of it. And your capability as an individual to acknowledge that despite something that ended in a dead end was itself a learning experience and you developed something along the way is worthwhile. And so if you look at this and say, well, I'm worried that this is going to pass me up and I'm not going to develop a skill set on it, it'll be worth it in some other way almost all the time. And so if you're worried about taking the chance, take the chance, do it. Research the topics, get involved on this. Colin says, I know this might be the wrong framing, but there are jobs, a demand side issue or a supply side issue. If the economy is doing super well based on the stock market and companies are flush with cash, are they not incentivized to spend that money in labor and investment since inflation eats away at companies sitting on cash anyway? So if we believe in the question of this, and this is the question, this is asking you to look at the way companies spend money, right? So why do companies spend money? What do they spend money on? What are companies for? What is this thing as a company? We can go back in time for this. And the first modern type of company, a joint stock company, originated in the Netherlands in the early 17th century. And the first corporation in this sense, and not just like the Swedish mining company from the 13th century, Stora, that divided shares of a mine between 8 people. But the modern corporation was developed to spread risk and also pool capital. And so instead of buying one colonial spice ship for the spice trade in Indonesia and bringing it back and risking that individually as an individual who purchased a ship that could go down most of the time, anytime, and bankrupt you. You pooled capital, you pooled resources together, and shares of a company were put together to buy a number of ships. They would go abroad, they would come back, and that profit would be shared with everybody. That's the idea behind the company. And it's still the same thing 400 years later. And so today, companies exist because they're pooling capital and they're taking that capital and marshaling it to make profits, to make money at some way down the line. And so either it happens next year, it happens 10 years, or it happens 100 years out. Even if they're not making money right now, they're designed to make money. Okay, so what does that mean? So how do you make money? You have inputs. You have these things that you got to put in. You either have to build a labor force, or you have to build some combination of labor and capital and equipment and fixed and land and factories and machinery and all this other stuff, and also all that technology that goes into it. And when you invest in all this technology and stuff, you're making your company competitive and engaging them for the future. And right now, companies are saying, if I have to spend $1 billion, I'm not going to spend it on people because those have diminishing returns. I'm going to spend it on the capital build out of AI, data, blah, 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 because that offers the biggest return on my investment in the future. And I think at the margins, truth or not, or whether that's truthful or not, companies are making this decision for that reason. And so since inflation, now the question of why companies maintain cash has been a good one. Apple sat on just a boatload of cash, and companies come under fire because they're taking that cash, the stockholders' money, and they're not doing anything with it. They should be marshaling that and investing it towards things that generate a return. And so that's considered an inefficiency of that market, right? And so there's a lot of critique for companies that do that. And so companies might, instead of spending the money on building the next best thing, do things like buybacks on things like stocks, which back in the 80s and 90s was a fun trick to boost your stock price. If you have only so many shares outstanding and the company wants to buy back half of them, boom, your stock price goes up because there's fewer shares to go around. And that worked for a while, but the recent research on this that confirmed in the last 10 years show that isn't really effective. And so and so it's an interesting question why companies choose to do with money or not do with money. They're hesitant also to appear, they might hold money because they're worried about appearing to waste money for consumers. And so that's the other piece as well. And so they want to be, especially for not consumers, for their stockholders, for their owners. They want to show that they're effective stewards of that money. And if there's no good investments, they'll move by doing nothing, which is also can be a rational economic move. If you're looking around and everything else has a negative present value, not doing anything can make sense, but it's not always necessarily the best thing. And so there's a lot of things in that question. But I think we're seeing a rational company response to technological change and a technological investment in these areas. Now, how this will pay off is the ultimate question. And right now, we've seen a lot of the companies catching up in profitability. The PE ratios aren't crazy pants, although they are high in aggregate across the market. But there's something that we have to watch in the future. Are they actually making money with these investments? And investor patience will run out on this in a few years, if nothing. If for specifically a few of these companies, not the big ones that are able to generate funds from this, but a few of these that aren't generating the type of funds that we're looking for. Now, Aaron says California needs to massively deregulate by 90% small businesses to drive business formation. Single family, 1 to 3 unit, ADU construction development. I mean, that's a much more succinct way of what I was going for. Build a lot more, all the things, easy permitting, easy licensing, keep businesses here. Robert says companies spend money in order to be able to supply their customers with products more effectively, but that is not the raison d'etre. That is not their reason of being, Robert. In that case, companies they want to supplying their products more effectively is how you become a successful company. Companies exist fundamentally, and this is we look at publicly traded companies in this way, and and we have this discussion, right or wrongly, they have to exist somehow as profitable enterprises in this space. And they do a lot of tricks to get there, right? They might appear, there's a lot of literature that goes into what these companies do and don't do around these areas. But to be effective and to be effective in a competitive space, they have to be able to deliver on their supply chains effectively, or consumers will find something else. Corporations are tricky things, in a free market. This is an interesting part. Free markets are very efficient ways of distributing resources, but there's a caveat. If left to their own devices, they become less free over time. You get oligopolies and then monopolies. And so regulation is necessary in some respects to ensure that the free market continues to exist. A good free market has a lot of different buyers and a lot of different sellers. And you find that does break down in some industries and at the margins. And maintaining a competitive market is ultimately better for consumers, better for their products, better for their customers in the long run, and better for innovation. All that stuff put together. So on the next level here, let's go back to that jobs report. Labor force participation rate going down. And I read the most interesting series of takes about this. So there's been a huge series of takes that pins this precisely on on white women between the ages of 25 and 54. And I was like, this is really interesting. This is an interesting take. And it is true that we've seen a decline in that demographic and among women in general, but we've also seen a decline in men. Biggest drop off we've seen in participation as a percentage of the people involved is actually among the labor force participation rate for people 55 years and over. So as we can see over time, this blue line, this is an eye test. So if you're looking if you've got like one of those 1986 monitors and you're just shaking this thing going, oh man, I really should have invested in color monitors when they came out. And you're looking at this thing, and the labor force participation rate right now is right now right. It fell right below. About 62% more or less. This is lower than what we had back in 2000. As the population ages, we expect that more people, a greater percentage of our population, will be retired. The participation rate rose between the 50s and 90s because more women entered the workforce. And then since that time, it's been very interesting. When we have a recession, participation rate drops and it doesn't come back. We're not in a recession right now, and yet the participation rate is dropping, and it is dropping especially among people age 55 and older. We are seeing that labor force participation rate among women actually rebounded since the last recession quite substantially and remains relatively high. But men, of course, on the other side, showing a slight drop off. We have infra-annual statistics that would be more useful for the 25 to 54 age group that stopped being reported about a year ago, unfortunately. But at that era, we could see kind of the difference between men in pink and women in dark, I don't know what to call that, greenish something. It's fascinating to discuss. But participation rate's a good barometer for the economy because if there are compelling reasons to be at work, people will typically leave if they have an option at home and they're taking care of kids and doing anything else, and this great job offer comes in, and their kids are grown, and the partner decides, hey, I want to go back in the job market, they might take it. But if those jobs aren't there, they might not. And this is a fascinating discussion. Worldwide corporate balance sheet cash is about $9 trillion, US about $4 trillion, Aaron notes. The new firm model is JP Morgan's Jamie McDimon's Fortress balance sheet model. Oh yeah, Fortress balance sheet is a model. That's fair. I have issues with it as a stockholder, as you should be as stockholders and various things that you own, but I encourage you to consider that consideration. I know it's interesting when you want. It is interesting. It's an interesting phenomenon. This is a bigger discussion we should have about that one. Larry says, still recall reading the book Men Without Work that documented the incredible drop in men employment over the last few decades. It is interesting. And we look at male participation as a focus, and it has indeed gone down. And that's that purple line. You know, it started at these levels, and it has. If you notice, one thing since the 1950s is a drop in male participation rates in general. And there's a very interesting question to look at. See a rise in women going back to the workforce. You see a drop in men over time. Participating in the workforce, meaning they have a job or they're looking for a job. There's an interesting discussion, and there's a mismatch between the job skills that are being presented and the jobs that are available. That's certainly some of it. There's a lot that's being talked about AI in this space, in particular in technological change and just general changes with the overall society in these levels. It's a very, very interesting question. I have I don't. I know it has many different answers to this, and Men Without Work is an interesting book, which is I think a worthy dialogue for some of these discussions. And when we think back now, looking at this, and when we gauge the health of the economy, Most of the time, it's never clearly all green and clearly all red. This is a sign, though, in participation that there is concern. And because we haven't really solved or wrapped our heads around it, it is an open question as to why there isn't more participation in this space. And some of this is going to be interesting to see. You'd like to imagine a situation, especially as we get older, where there's greater participation rate among 55 plus. You might also counter argue that and say because there's more people that way, there's less than an aggregate because there's a surge of retirees. Most people just don't want to work yet. Maybe they will in the next cycle. In this one, U.S. states, percentage of people aged 25 to 34. Now, we're going to go in a bit about our inflation section now. So I'm going to go from the jobs market centered one to a little bit more on inflation right now. So, uh, the cost of living is an interesting one. There was a interesting write-up on that Matthew Iglesias had on Substack that I found very interesting. And he talks about sort of the reasons that the younger generation in particular, I mean, people, especially under age 30 are really, really hesitant or really critical of capitalism. And for very good reason, right? Because what do you see? There are two real goods in the United States that are really, 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 really inordinately expensive. And one of them is housing and one of them is healthcare. Now, when you're young, you don't spend a lot on healthcare, but you do spend an inordinate amount on housing. And housing is also a market that is actually very, very has not a lot of free market in it in some ways, and I'll explain why. There is so many restrictions on things that you build, the density of building, parking minimums, zoning restrictions for the last 100 years. It is a very expensive good. And if you are very, very, and there's different levels of opposition to building housing, whether you're on the right or the left. Both sides have different perspectives on this. And so if you're on the right side of the political aisle, you often buy a single family house because you're buying the right to buy a single family house in an area. You're purchasing as part of that good the right to be in a region of single family homes. And if you're on the left, you oppose this building, and there's a slew of very, you're looking at environmental concerns, you're looking at all these other pieces, you're looking at ways you can possibly legislate more affordable housing in more reasonable ways. And housing as a whole is such a big good, and it's such a big percentage of people's paychecks that the way they see capitalism is through one of its failures and the failures of our society, which is not really capitalism's fault, but it's a separate issue, which is the just outrageous price of housing that we have. And if we look at the percentage of people aged 25 to 34 who spend more than 30% of their income on rent, you see it in California, Nevada, you see it in Florida, even Louisiana and Georgia, of all places, they have it. And then three tiers down, if you look at this, those are areas where over 45% of the people are spending more than 30% of their income on rent. That's a lot. That's hard to justify in that space. Very interesting market. Melanie says, "What's up with Vermont and New Hampshire? Those are both expensive housing markets." This is an interesting chart. I hadn't seen one like this, Melanie, and I picked it because it was focused on just the 25 to 34 age group, and so they're looking for a very nuanced part of the market. So it might speak more to rentals. Vermont and New Hampshire are expensive markets. They're less expensive than Massachusetts is, and downstate New York, but they are expensive. Burlington, Vermont is pretty expensive. I was looking just whimsically at prices there last year. Colin says that US healthcare is a giant scam. IRRC said something like an excess of 30% of healthcare is purely on admin work. That's true. Healthcare is 17% of our GDP expenses, and we don't have an answer to it yet. So it's fundamental we figure out a reason why this is and to actually fix this. Now, CPI as a note. So you heard a bunch of news about our CPI print. You're like, oh, 3.5% year on year. Way higher than the 2% target from the Fed. The Fed, of course, which controls one big interest rate, overnight lending to large banks that has a ripple effect on all the other rates in our system, is the Fed likes to target two things: full employment and inflation near 2%. We have been above the 2% inflation rate for about 64 months now. And in that space, the Fed is very eager to get us back there so it can so it can bring us back to normal monetary policy. However, we had a war in the Middle East that started in March, and since that time period, we've been experiencing a lot of energy-related price increases, and that shot CPI up to 4.2% last month annually. And then it went down to 3.5%. One headline I read said, "Oh my goodness, this is the largest drop in CPI that we've seen in since 2020, two or whatever." And I was like, "Oh my God." It did go down 0.7 in a month, but it went down because energy is volatile and those prices are volatile. And because there was peace last month, relatively speaking, in the Middle East, prices eased off a bit before going up again. We saw that decline here, and I'll show you what that means a little bit. And so, energy is really the story of the last 3 months and the prices that we've seen. So, if we look at year-on-year changes in things like fuel oil, gas, airfare, all up 26, 27, 43% over where they were last year. And with that, you have weird things like motor vehicle maintenance, tobacco and smoking products. You've got fruits and vegetables and hospital services and electricity and apparel. And then at the later, strangely, we saw very little inflation in things like new vehicles, as well as in dairy. Ah, goodness, well, there's nothing I need energy for when I just have milk. And then you've got other things like used cars and trucks dropping in price and motor vehicle insurance having gone up so much, but then actually clawed some of that back down 4% in the last year. Now, if you look at the month-on-month changes, though, prices are still in this flux, where we saw the decline, where we saw some of those tailwinds help drive CPI down from where it was the 4.2% rate last month. We're in fuel oil and gasoline. We had a shock to the energy markets. That shock since fell off. And as a consequence, we saw a decline in those prices. The Fed can't do anything when we have a temporary economic shock. They can't raise interest rates based on a couple month journey. If there was peace in the Middle East tomorrow, perpetually, it would still be a long run before we saw these prices fall back to normal because it's very easy to raise prices. It takes a long time for them to fall off. Colin notes real wages for doctors have decreased in the past decade. It's not going to healthcare. This is good. So Colin's additional points about healthcare are also interesting. I don't want to sweep those under the rug. It's not going to healthcare workers. It's just absorbed by insurance and admins. And the people whose job it is to bill you and deny you healthcare are the ones getting paid more. Oh, administrators. That's why when I was an academic, I'm like, I'm going to go into administration, I said when I was a boy. I'm going to make sure I'm just a drag on the system. It is true. And a lot of those admin roles, there's nothing. Admin will really teach you about why admin exists. And some days you're like, there's no reason for this. And some days you're like, there needs to be a reason for this. And some of this is litigious bureaucracy. There's a lot of ways, the whole system is very Byzantine in healthcare and academia and other places. And this is a big discussion to have about how to physically simplify it. So you don't need as many admins and you can actually create better economic outcomes for the people involved. And then let's go a little bit about something else too. And so you might be aware that we have a trade agreement with Mexico and Canada, the U.S.-Mexico-Canada Trade Agreement, thusly called USMCA, and that the U.S. government has decided to end the trade agreement, which potentially could raise prices on a number of goods that we trade in between Canada and Mexico. Why is this important? Well, let's take a look at this. Canada and Mexico actually are our two biggest trading partners, and they dominate U.S. imports in huge categories in major consumer goods. I'll pick out a few of these here just for your perusal. Number one, and HS codes included for those of you taking notes, petroleum oils and bituminous minerals. We import about $140 billion worth last year. And from Canada and Mexico, they made up about 94% of that. It's about 67% of that. Motor vehicles for the transport of goods. We imported 96% from Canada and Mexico. Insulated wire, boards and panels, air conditioning machines, refrigerators, and my favorite, spark ignition reciprocating or rotary internal combustion piston engines, of which we import 12 billion. 57% come from Canada and Mexico. So what this means is it doesn't mean that getting rid of this trade agreement raises prices. It means that it opens the door for things like tariffs. Now, tariffs, of course, you're like, oh, tariffs. We're done with tariffs, right? Because we had the Supreme Court, we had other things, we had concerns, we have the Trump administration saying, it's off the newsreels for a little bit of time. What is the deal with tariffs right now? And so the Federal Reserve Bank of New York conducted a regional business survey in May of 2026 of their businesses and asked, hey, look, tell me about tariffs, where you are with tariffs, and are you done with tariffs yet? And the thing is, we're not done seeing price increases with tariffs. We went over last month or 2 months ago. We discussed how the impact of tariffs looked, and we found that that prices would likely have continued to decline for things like wholesale goods, a lot of those input materials that corporations need to build other stuff, but instead increased in price due to tariffs, and that resulted, and that's certainly not helping our current high inflationary situation, which is eating away at real wages. And you've got two categories of firms in this category: service firms and manufacturers. In service firms and manufacturers, about half of the firms, 53 and 56%, don't expect to see future tariff price increases because they're already there. The surprising part is in the other half. 47% of service firms, 44% of manufacturers find that they are still pricing those tariffs in. And there'll be additional pass through coming ahead in the next 6 months. And there's likely to be more pass through beyond 6 months for about one in every six service firms and one in every 14 manufacturing firms. Fascinating stuff. And Aaron's absolutely right. So I look, even by the title of this article, the caregiving pressures on women in the workforce are drastic. It's so expensive to maintain childcare. The opportunity cost of working versus not working is significant. It's creating a huge, huge economic dilemma in the and as we look for this, especially as many people decide on career or child or something in between, and it's so hard to do both things, and it needs to be available in both cases, and it's just something that is just a big question. And then back to Colin on healthcare. The supply of doctors is artificially limited by Congress. Oh, agreed on this. Colin, if I could mint doctors, I would mint them tomorrow. Same thing with professors. That'd be contrary to my business environment too. Trust me. I'm aware that possessing, working at an R1 research intensive university, getting full professor, doing this kind of things is itself a deliberate like filtering pool. But in your particular point as well, if we could mint this and make education, healthcare, and other places cheaper by increasing the supply, that would be very economically rational. I will not oppose it, although many would in my field and in healthcare. I'd imagine many other and many physicians might pose that as well. Fascinating question though. Artificial limits on supply, bam, higher costs in healthcare. Colin gets it. Oh, Colin, I just had this active discussion. I was working with a New Mexico medical group around this very question about how to get qualifications for imported physicians. We have a real medical crisis in New Mexico. A dearth of physicians live here. And we were successfully, finally, through great initiatives, re-evaluated our malpractice reform, which kept a lot of physicians out. I think we desperately need mechanisms to bring in additional physicians if we aren't going to create the supply domestically. Absolutely. I'll die on that hill. I mean, we can fight on this and be like, well, we need more doctors. Whatever, you increase the supply of things we need, it'll make things cheaper. Colin, add to this.
Yeah, I mean, I'm very passionate about the topic because I care about good healthcare. But I mean, I already did a quick dump on my, what I know to be true. So everyone, feel free to not take my word for it. Do look it up. There's a lot of artificial limitations on doctors and even nurses, which is why a lot of nurses aren't paid extremely well, and our healthcare situation, despite being the most expensive healthcare in the world, is clearly not delivering up to par. And I can say that confidently because I've experienced healthcare in Taiwan, which is one of the best healthcares. Honestly, it's not perfect. The doctors in Taiwan could be paid more, but the situation there is significantly better than what we have here. Off my soapbox now.
No, that's a really good point. Colin, in that magnificent week I spent in Taiwan, I had nothing but positive things to say about the entrepreneurial culture, people just doing stuff and making things happen. And I'm so glad you got to experience the healthcare and can affirmatively say that they do well. It's interesting. We just don't have a good answer to this question. And there's not always perfect answers in other places. I know people will say, places in Europe and other places there are lines and other things and issues. It's very hard to get doctors, I think, in the United States as well, even though you're even with this in some areas. I think in certain major cities it's easy. I think it is such it's impossible in New Mexico, and that's a huge issue, and it's a huge issue in a lot of states in the country too. There's literal deserts, figuratively and literally, with medical providers in various areas.
It
And
needs to be dealt with. And I think it just falls under like the two things we know are good for a society, healthcare and education, because a healthy and educated population is productive. And when they're productive, they pay taxes, which pays for itself. But for some reason, this isn't something that politicians are willing to run on generally because it takes decades for it to really pay off. And we're all dealing with the short-term memory. And this is just, I don't know. I don't know how to fix
decades.
it. I
So do you
just
think
know
we'll
what the
have
problem is.
Colin, as an AI expert, can we devise when will our electronic doctors be effective and licensed to do everything they need to do? So I can just we just get around. It's like electronic professors. You don't need to listen to me. Listen to AI, Riley. Much more efficient with questions.
That's one of the biggest problems because, and I wrote this a while back, which is most AIs can ace the medical exam, like ace it blind. They don't even need to read because they've been trained on all of it. They know how to answer all the questions, which is weird because if that's the exam we need for doctors to become licensed doctors,
Mhm.
then either those AI are good enough to be doctors, or the test is not good enough to judge doctors. Like it's an either or situation there. I'm open to other interpretations of that fact, but
Mhm.
it's a very interesting fact. If the bar is here and the AI is meeting that bar, you have to treat it as a doctor. If you don't want to treat it as a doctor, then why are the people who are meeting that bar being treated as doctors, right? You can't have your cake and eat it too. Obviously, it's a lot more complicated because doctors come with residency, and the whole point of a residency is literally just cram as much experience into you as possible in 6 to 8 years so that you can function under stress. Um, but that cram experience into a doctor, that is literally something that it's just context. And that context can be preloaded and trained into any AI if one were to want to do that. It's pretty known that AI is very, very good at looking at scans for like X-rays and radiologists. That doesn't mean radiologists have lost their work. It just means radiologists are there to verify the work. And the whether or not you want a to replace doctors with AI, I don't think so. But you definitely want doctors to exist because they can make a human judgment. But for routine stuff, like, hey, I want my blood test or something. I went to see a doctor recently for a physical. 99% of the time, I feel like a physical or a healthcare checkup does not require a doctor, except it requires a doctor. Do you know what I mean? It's like, why are you bringing the ultimate expert in for something that is routine? They should be focused on something else. And that's just how I see it. And like for some things that are routine, I highly think of it in engineering terms, which is like, hey, there should be a triaging issue. For something that's basic, have an AI run through it. It's smart. It has all access to your details, right? It has the context of your health history if you've been having a record, and then it can immediate make judgments without being tired because it's never tired. There's no, oh, you're seeing the doctor at 5 p.m. He's hungry. He's had like four patients yell at him today, and he's just like, I'm really done with this. So he just kind of speeds through your checkup. It's just kind of stupid. Um, so there's definitely a reason to have AI in the healthcare is my ultimate conclusion. Whether or not we're ready for it as a society, that's a separate question, right?
Colin, I love the tough love. If it acts like a doctor and it does all the things that meets the bar of being a doctor, it's a doctor. This is really interesting because I say this back to companies who are like, oh, I got to bring all my workers back in person that don't actually have productivity measures. It's the same sort of energy. Like I'll say to them, I'm like, you want to bring them back because you can't measure what their productivity and performance are. And if you measured them better, you'd be able to maintain more remote workers. But I like it. This is interesting. Michael's comment's hilarious, by the way. And Robert also pointing out that U.S. has lower life expectancy than most countries. We are ripe for vast technological change in this area. Michael, actually, I didn't mean to amputate. I'm sorry. Uh, this is hilarious. Oksana's got a good point. Oksana AI is a black box, even though it gives the correct diagnosis. It cannot explain why it gave such a diagnosis. How do we know? It's a really good point. And Colin says you can ask it to give that diagnosis reason. Yeah, that's good. That's good. Colin being licensed. We got to do this with
Yeah.
Colin. So Colin's going to come back with he's going to learn everything AI has to teach him about medical practice. We're going to set him up shop in downtown and he's gonna operate an unlicensed medical practice and we'll see. We'll track the outcomes and we'll
Uh,
see how it
I'm sure
works.
it's much more complicated to become a doctor. It's
No,
just,
just run with it, Colin. This
yeah,
is good.
right. Aaron, I
Don't be
just, there's so much going on where I feel like the expertise of humans should be limited, should be only leveraged when a human is
yeah,
required. And we
right.
haven't successfully figured out like what jobs don't require a human input. But for
I,
example, a blood test, I don't think that generally requires human input, unless something goes off and you can write in rules for like, hey, if there's any anomalies, pull in a human. But if it's just pretty routine, I just don't see why you need a doctor to read through your blood test and give you the same exact answer that an AI would anyways, right?
mm.
Like that's a waste of their time and my time, and they should be triaging or dealing with much more rare diseases or whatever that AI has not been trained on.
Fascinating stuff. Maybe the future belongs to the medical cyborgs, the people who can allocate AI well, use it efficiently for certain things, and perhaps maybe but with the human component as well, that nuance. There is to that point a certain lack of trust, I think, for good reason, between AI and maybe my son's generation, maybe my great grandchildren will find it's a very interesting thing. When technology is invented, there is a process by which we become used to it and we become trustworthy of its ability to do certain things. And I think for something as critical as medical care, it's going to be a ride. But I think I'm above anything else. It at least has so much promise as to where we could go. Oh, Elise wrote in a 7/8/26 ProPublica piece, Wall Street wants to change the rules for 401k. Financial firms want a bigger piece of the 10 trillion 401k plans, and the Trump administration is planning a regulatory rollback to encourage less regulated and often riskier investments. It will gut protections for workers' 401ks, opening up to risky investments like crypto and private equity. The lead of this charge ran a company that defended employers from worker lawsuits. Interesting. So I've got some thoughts, Elise. This is interesting. So when we think about this is an issue that goes back with. So I'm gonna give you my opinion, and then your question kind of nails the answer on the head. And so one of the issues that we've had. So when we think about 401ks, they've only been around since about 1980. It was 1978 or 79 that we passed the law that enabled IRAs to exist, individual retirement accounts. And after that, 401ks came into being. And 401ks, if we go back to the 1970s, about 40% of Americans had pensions. That number is about 3% or less now. And 401ks have made up the remainder of it. If we look at pensions versus 401ks, they have different outcomes. And certainly from a perspective, 401ks have many advantages. It's a market economy. The returns are often as great or greater. But you often, even in positions where you're given a fund or given a fund that's targeted a retirement date, what changed in between those periods was we provided people the choice without providing the component financial literacy to manage that choice well. In investments, and an example that I'm gonna elaborate on this question, Elise, in particular, is why we have hedge funds versus why we have mutual funds. A mutual fund is something you, me, and everyone else can invest in as part of our portfolio. You have the mutual fund has to disclose the investments that are within it, and they are limited in some respects to the level and of types of investment that they can invest in. Hedge funds are open to people with that are accredited investors. That is typically defined as people with $1 million or more, or things like institutions. And the reason the hedge funds operate that way is because they can take risky positions. They have very little reporting requirements, and they're there to maximize returns any way they can. But they can also take these risky positions because people will lose, because the people who are investing in them are accredited, and they can stand to lose the amount of money that they're actually investing in. And that's how that thesis works. So we have great precedents for actually dealing with this question. And I have to tell you, with 401ks, I am not in favor of opening up to to riskier investments. I am in favor of making 401ks financial literacy mechanisms part of 401k policies to encourage people and have automatic enrollment at the highest possible level, followed by opt-outs for people who want less to protect themselves in retirement. People chronically underinvest in 401ks. And people could stand to risk substantial amounts of money on this, which would benefit the financial services industry, but it would be bad for the long-term health, and it would increase the tail of people who are going to be losing a lot of money that way. Very much, I'm in favor of kindly our existing legislation around this. I don't see a need to make it different. I think the risks are much greater than the benefits. I think we have all kinds of things. People can, as it turns out, open your Robinhood account and invest in crypto. People can figure out ways now. There's other ways to invest in private equity and other limitations on that too. And the Jobs Act of 2015 helped pave the way for that. And so I encourage people to do those things. But they can do those things outside of their 401k, keep the 401k for retirement, make people have uh, more stuff. I like this debate we're having about AI in this space. Colin's doing some heroic work in here. Cook, Colin, I'm going to keep letting you cook. So this is good. This is good. All right. Levelized cost of energy comparison, historical. So this is interesting. So Lazard came out with this um, measurement about energy costs. And what's interesting is we've seen higher input costs on after years of 0% interest rates. We've seen higher interest rates the last few years. We've seen a lot of build out in energy, but we've also seen energy costs increase after a long period where they've been declining. And one of the formulaic structures we have to think about in the future of the United States for economic prosperity is we need a large amount of clean energy very cheap. We need cheap, clean energy. But the interesting part about this, and I got into this because I've heard it's taken for granted. Data centers are increasing the price of our energy and all these other things. And so this chart was interesting because it added some nuance to this. This is adapted from the Lawrence Berkeley National Labs in the Brattle Group April report about load growth, so the amount of increase in the physical amount of energy we're using versus the residential price change that we've seen in changes in cents per kilowatt hour. And if you notice on this list of states here in this different respects, if you take this graph where you're looking at price changes in cents on the left axis, and finally on the horizontal axis, you've got this increase or decrease in load. You've got states like California, which actually decreased its load between 2019 and 2025. Good job, California, but simultaneously increased the prices 8 cents per kilowatt hour during that period. You have states like North Dakota that had a 40% increase in load. They're like, energy controls out the window, and they've seen actually a 1% decline in prices. New Mexico, right there, my own house, right? I'm running a hot tub out back. I've got like a computer I haven't turned off since 2019. And I've got other things that I'm not the most energy efficient on, even though I ostensibly support greater, more and more energy efficient units. And my energy bills are absolutely not high. I think for air conditioning, I like to keep my home at a comfortable 38 degrees Fahrenheit. That is the temperature of my icy heart. Or more tentatively, what is that? 4.4 degrees Celsius. And I just like to make sure it's nice and low. It is amazing actually to see the differences that we're seeing in energy prices across the country, despite the increases we've seen. But the story is, it's not just about AI data centers. It's about regulations. It's about the very patchwork of different regulatory commissions and utility companies that operate in different states. It's not just as simple as it is in other markets. As you know, utilities are very highly regulated because they have to be. They operate effectively as monopolies in states where they operate. And so you have to regulate them effectively to make sure that the prices remain fair. And there is noise here that doesn't exist in markets because you can't run. We can't really have a free market in energy because although good we could consolidate the aggregate system and figure something out nationally or whatever, but we can't run 30 different power lines for 30 different companies across my front lawn. It's not physically possible. And so utilities are fascinating things because they operate as these sanctioned monopolies in the regions where they work. And that does limit their market, the market fluctuations within them. And because of this complexity, rates, at least as it pertains to residential rates, are a much more complex picture um, in this market right now. A couple notes. This came from an IMF report. I want to thank Aaron. Aaron sent me this email about some of the oil shocks and their inputs on prices. What's been amazing about the oil price shocks that we've seen is how they aren't fully reflective of the historical disruption in oil markets. So this war in the Middle East right now, collectively, we're 1 billion barrels down are in the 3 or 4 months that this has been going on. And that is greater than at this time the effect of the Gulf War, the Russian War, and the Ukraine-Iraq War. And the fact we've seen those price changes only be what they've been is actually kind of amazing. Gulf production down 13.6 million barrels per day from March to May. But since that time period, we've seen increases in lower consumption, inventory drawdowns, other production costs make that up. Fascinating to see. Now, because of the energy costs leading the way, we've seen United States that rose our inflation, and the United States currently has the highest inflation in the G7, these 7 large industrial economies. But all economies have seen increases in inflation due to energy costs. Now, home price indices. So here's a story of almost hope. So the last year we've seen some markets in particular drop in their home price indices. Dallas, Las Vegas, Phoenix, Tampa, Denver, Seattle, cities that have, except for Seattle to a certain extent, have built a lot in that space. And you've seen increases in places like Chicago, New York, Cleveland, and Detroit and Boston. San Francisco is at a 1.3% rate year on year. And if we go back 10 years, the increase in San Francisco housing has been about 59%, 15 years about 168%. So the all-time high, we're 48 months off the high in San Francisco. So what does this mean? This is a Charlie Bilello chart, but it's interesting to show just how the housing markets overall have leveled off in aggregate and are at least sitting below their all-time highs in most 16 of the 20 markets. We're below our highs, which is encouraging. Albert says, I know it's not really our geographic interest. What about 35 straight months of housing value decline in China? China had such a build out. And one of the challenges for China is we're seeing a deflating of this really significant building boom that they've had. And the way it's landing is different than it has. There's not really a comparable market to the United States in this, but it's huge and it's affecting a lot of capital decisions for these families in China, of course, that are making these choices on the nature of their build. And of course, I'm not getting in the details about ownership versus long-term leases and how they're roughly equivalent and all that other stuff that are nuances of the Chinese mainland system anyway. And you think about housing value decline in China as a function of overbuilding and overgrowth. And that is comparable in aggregate to perhaps the push pullback we've seen in Austin, but not really in a different sort of way, completely different environment. But fascinating question. And Colin says Chinese healthcare is so good, the 99-year lease needs to become 120 years soon. Oh, this is interesting, fascinating stuff. Michael, I'm glad. I love to see this human cognition debate here. This is gonna be good. This is just magnificent. I love parallel conversations as they happen. So I'm so glad, Michael. Keep going. Keep going. You and Colin go. I mean, this is very good. I'm monitoring it. I gotta keep going. We've got the 14 people, no, got 5 people left waiting for the last slide so I can finish. No, annual. So this is interesting too. So I showed you 2 months ago. So the Washington Post article that looked at, I guess it was New York Times, that looked at the monthly market rent versus not rent, but the housing price versus the amount of builds that happen. And as it turns out, the amount that we build in rents affects prices the same way. And so if we look at the typical market rent in Zillow, if we look at this down at the bottom and compare that to the annual average building permits, there's a clear relationship here. Places that have low rents often build a lot. Like Austin is a place where you build a lot but have a low rent. You have no places that build a lot and have a high rent. So this top right portion of this chart is empty because it just doesn't exist. It's not an economically possible outcome. And so if you're San Diego or you're LA or you're San Francisco or you're Boston, New York, or San Jose, even if you're cruising at this really, really just languished building level, build more units. Let's move some of those values to a point where you can show benefit. And people often argue that when you build a lot of units, that causes negative price returns and or you build luxury units only or whatever. And we find that through something called rental chains, and this is a process documented in Finland and confirmed in a bunch of other studies, both nationally and internationally, that just building something frees up apartments. And so if I build luxury real estate in my area, people who can afford luxury real estate that are living in middle class residences move to the luxury real estate, freeing up middle class residences for people in the middle class who might otherwise need it. And so even if you have to build anything, even building anything is better than building nothing. And so I would encourage you to build, 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 make it happen, make it work in this as well. And so this is fascinating. If you look at the Bay Area in general, let's dive deep a second and let's take a look at what's going on in this magnificent duality that we have in the Bay Area. And so home prices, yes, San Francisco in general, you saw up slightly. Not the story across the Bay. You've seen actual prices are flatlined, even declining in places, in most places in the Bay. A little bit farther from it, you see some slight increases, places like Concord, north of and Livermore is actually also in the declining area too, year on year. The peninsula, though, in Marin, you're seeing just increases still across the board, driven, of course, by where these AI-driven jobs are and these tech jobs are present. Fascinating questions. And Robert, this is a good question. A lot of California cities have a shortage of space for new buildings. Oh, Los Angeles in particular is surrounded by oceans and mountains. But there's one thing they can do, Robert, and that's build up. And that's what they need to do. And so Robert, fully aware, and I want to reiterate, yes, I'm in San Francisco, and yes, I'm not in San Francisco, I'm in Santa Fe, New Mexico. My dad's from a Bay Area resident, and my grandmother. We're 49ers on my father's side of the family. Part of the problem originally, right? Peter Donahue, my great uncle, who built a railroad and founded what became the company that became Pacific Gas and Electric. Sorry about that. You've got this amazing opportunity in a consolidated area to build upward, and it's just not permissible. Parking minimums, lot restrictions, zoning, all that stuff. Toss it out. PG&E is my fault, Albert, so you can take it to town and go away. But it was after, Peter Donahue was just a special character. His sister was my ancestor. But there is a fascinating discourse around this because Robert's intuition is what most people like would come up with. There's no land, and you go there, and you're absolutely right. Consolidated area, but you can exist in spaces where you can live in an earthquake-prone region with high-level apartments. I give an example. Osaka is a great example of this. I was just in Osaka last year, and I was having a conversation with the faculty members, and I'm like, look, what does it cost to live here? And he's like, you can build here and here, and the rental prices are here. And there are expensive districts and not expensive districts. But he's like, our students, they buy individual apartments for the equivalent of $400 a month. And I fell off my chair when I heard that, because that's absurd to think about. But imagine if it was possible to get a comfortable apartment on your own for the equivalent of $400 a month in the Bay Area. It would change the skyline. It'll change the feel of the city. It'll change everything about the city. But it'll make it livable and also encourage more people to live here. So I'm very much in favor of that. Very unpopular opinion. I would move. I would have a high-rise apartment in San Francisco. I would move there. I'd get one of those low level. I get a faculty position over there instead. It would be great. And you're priced out this way. Albert, Japan is a very cheap place. If I took you really, Tokyo would be really affordable, but that was as a tourist. Imagine if you're a local, you don't pay much, but you also don't make much. Melanie says a lot of infill space here in Oakland is unappealing ex-industrial land on marshland with heavy pollution in the soil. That's where I'm going to live, Melanie. I'm going to have my estate. I'm going to build one of those estate. I'm not going to build a large. Yeah, maybe that's what I'll do. I will protest that by building a large single-family estate on that open, contaminated marshland. And as I radioactively walk to work, oh man, this is great. You guys are so fun. It's just, oh, it's gonna be fun. Reilly White Man's right there. Is it in the harbor? It's maybe I let the tide come in. It'll be one of those things. But it's an interesting idea. Rents, on the other hand, interestingly enough, rising, still positive everywhere you look. From Sunnyvale to San Carlos, from Richmond to Walnut Creek, prices are going up everywhere, with the exception of, and I wanted to point out this because I found this very amusing, the South Kennedy tract in Fremont. So if you, not even in Fremont, it's on the South Kennedy tract. Where is that? Is this part of the city of Oakland? I don't know. But anyway, so that's where you find your cheap rents, people. So that's where Albert's List headquarters is going up. South Kennedy tract in Oakland. Yeah, that's right there. It's what the Home Depot is. So there you go. Never mind, right there. How convenient, because it's going to be a fixer-upper. All right, so one of those things. There are IPOs tentatively in San Francisco are going to send rent prices soaring. It's true, and you're seeing that right now at the cost of houses here. And then with the rental price in the same area, already rising in these areas. This is fun. This is deep. The Michael Colin conversation is just, this is happening. Melanie says the infamous Home Depot with the RV encampment. That RV encampment, though, minus 1%. Telling you, rental deals on this. I'm looking at the map. It has a slight slice of Poor Honey's used furniture, too. That's also fun. 4.4 rating on Google. Annualized total returns by decade. So stocks and bonds. So this is an interesting, when we talk about 401ks, when we talk about investments, and this is Charlie Bilello, he has a lot of interesting charts that he custom makes in this. He does creative planning, has this really nice sort of economic focus and finance focus. Check it out. But stocks and bonds right now has a very interesting history. If we go back 86 years or so, which is kind of like a tentative thing that I take from basically the late 30s, early 40s to today, we average about an 11% return in the stock market. That's pretty good. Most decades, we return pretty well. The last decade, 2010 to 2019, we're up 13%. So far in 26, we're up about 15% per year. That's why people invest a lot in things like stocks. There are some decades where we don't do particularly well. Two of note was during the Great Depression, when in aggregate stocks dropped about 0.9%, and again in 2000 and 2009, between the top of the tech bubble and the bottom of the financial crisis, we would actually lose money if you invested during that period and didn't do anything else. You'd actually lose about 1% in overall market performance. Those events are very rare. In aggregate, unlike gambling, the market you invest in, if you invest in enough things and they're diversified, you typically do pretty well. That's why it makes sense to invest in them. And on the other side of this coin, you've got things like bonds. Now, bonds, of course, are debt instruments. Companies issue them, municipalities issue them, promises to pay you back, and they pay you interest for doing so. Bonds have had like the worst 6 years I've seen on record in my lifetime, and even beyond that. You have to go back to like the 1950s to 50s to see bonds perform this poorly. Bonds are often an alternative investment that people invest in because they have lower highs, but higher lows. They're often less risky than other investments, generally speaking, especially the Treasury, the Treasury bonds, which are backed by the U.S. government. And so all of this is very interesting to note when you make your investment decisions. But right now, we're tracking with a particularly strong stock market and a particularly weak bond market. So are we in a bubble? So if we look at the data on this, comparing it to the dot-com bubble from 1993 in 1999, we saw about a 1,100% increase in the prices of stocks. In the AI boom, we've seen about a 569% increase in stocks. And the 2008 to 2009 boom, we've seen about a 569% increase in stocks. And the 2009 to 2011 boom, we've seen about a 1,000% increase in stocks. And the 2011 to 2015 boom, we've seen about a 569% increase in stocks. Both like 93 to 99, we saw 7 straight years of 19.9% of greater returns. With the exception of 2022, which had a bear market, we've seen the tech market also show incredible returns in this period, better than the US stocks as a whole. There are things that look like the dot-com bubble, but things that are a lot different. The dot-com bubble was full of firms that didn't make any money. The AI boom is full of firms that are making tons of money in this, but it's often hard to figure out where that money is going. And especially for those new firms starting up, not everybody can change everything in the future. Only a few firms are likely to ultimately be the most successful in this space, although many firms may reach some level of moderate success. There will be firms that end up failing. And when those failures happen and how those failures happen will tell us a lot about what's going to happen in the future. And then lastly, it's interesting if we look at semiconductor companies, free cash flows, they're selling a lot of the stuff that AI firms use, prices for free cash flows, which shows the amount of money that they are earning. It's an alternative profit measure, are through the roof. Hyperscalers are spending money on build outs right now. Their free cash flow has tanked. Those are things like Amazon, Google, Meta, etc. Rocking and rolling. Colin, you're here to rock and roll. I know it. I see it. He's got to end
Well,
something,
there's
start
multiple
something, or
threads
fight
going
something.
on, but I just want to say there's a lot of interest in the media on the rising cost of tokenomics and uh, the question of a bubble. Um, Everyone probably may have heard through the grapevine that NVIDIA is opening up a new way to pay for compute, which is called rev share, which is you don't have to pay cash, you pay a portion of future profits to us instead. And
Oh
there's
my
two ways to
goodness.
read that, which is one, NVIDIA is saying there's no cash soon, or two, the positive one, which is NVIDIA sees that there's higher revenue to be had if they get revenue share instead of taking cash up front, right? So it's either or.
And by the way, I have a theory that I've been throwing around too lately that if this kind of mess that we see on this chart continues, knowing who we are as a country where we privatize our gains and socialize our losses, I'm thinking that at some point, um, the hyperscalers go to, they all band together and they go to Congress and they go to the Senate and they say, there's this wide gap between the capex we've spent and the revenue that we've made. And even despite all of our marketing and all of our promises, we are not going to hit our goals of infinite growth and infinite users. So what you're going to do is this. In the next um, National Defense Authorization Act, you're going to take the capex to revenue gap and you're going to print a bunch of money and you're going to give us a soft bailout. And in exchange, we're going to give you all of that data center capacity that we did not use, and you're going to use it for uh, the United States social credit system. You're going to use it for surveillance, and you're going to use it to gather data on every conceivable thing that you can possibly do on America's businesses, commercial interests, national security interests, and everything in between. And so for all the things that the AI companies will not end up doing, the American taxpayer will be on the hook for pretty much their own surveillance and their own violation of privacy. Any thoughts on that theory?
That's a lot to unwrap there, Albert, on that secondary question. So this is a good question. So let's start with the first part of the thesis in this, which is not wrong, right? So when we think about the socialization of losses,
Yeah.
and so this is an interesting question. And so AI, the question is whether we view the input, which is clearly driven by the build out of data centers and infrastructure, driven by AI and technological changes, for companies whose primary business is going to use AI in some way. And I want to iterate, and I want to be specific when I mean that way. Google is in Amazon, in Meta, Microsoft, Oracle. If we consider that group of five to be the ultimate hyperscalers, they have all of them, a uniquely diversified revenue stream. Each of these companies, we can give a talk about how Microsoft isn't just Windows, Google isn't just a search engine, Amazon, of course, is a globally present, distribution slash center. And they're all throwing money into this as an efficiency paradigm. And I don't think so. I guess my point is I see this evolving differently. I see this being offset first by, so let's say if something went sour in the hyperscaler market, I would see that being offset by their primary business revenue model streams in different ways. And you might argue and counter argue that, hey, AI is going to change all those. And if they're not able to get ahead of them, I mean, realistically, the moat for each of these companies that they've built is gigantic. The moat is that individual, that company level protection they've built through years of doing business in certain areas. Everyone uses Microsoft Windows, right? Everyone uses Amazon. Everyone buys stuff from Amazon, whether they like it or don't like it. You can't build overnight a distribution network that's global and can provide as many things as it does. So the failure of this, you can see them back off a bit. You can see them back off for failures. I see this not ending up in that position of just a detriment to this. I think we're going to see the free cash flow investments taking place will either pay off, and the companies will be able to maximize their growth because of somehow utilizing AI in a positive way that creates this an improvement to their business model and an improvement to overall profitability. Or if it doesn't, what will happen is these costs will result in cutbacks organizationally, stuff that not just the layoffs that we've seen, but greater layoffs, more profound layoffs, different business models, different things, but they're not going to give up on the secret sauce that they have that makes them profitable. And so I think my view of this is nuanced. I think my fear for this is the rug comes out of the AI marketplace. I think there's all right. So if I were to separate this differently, I have two big fears. One is that there's the general investment on AI. Investors get impatient, they start pulling the plug. We saw a little bit of that where it merged with private credit back in March. So the private credit market, there's a provider of private credit in the market, and private credit is debt that we would buy is as individuals or institutions or accredited investors of companies. And this has changed just the capital stack of raising money for a large number of organizations. And you had that run on um, one company's private credit during March that JP Morgan had to step in. They had to say, look, everything's fine. Private credit's still solid. We got all these positive things to talk about. In the nexus of that is there's so much money floating around towards AI, and so many of it is in relatively illiquid things like private equity and private credit, that there is a fear that if investors ask for redemptions of these things, they'd be unavailable to do so, triggering other fear in the marketplace, which then pulls investment back, which creates a recessionary environment. That, I think, for me, that series and sequence of events, lack of redemptions, there's something that causes a lack of faith in AI, a lack of faith in other things, lack of redemptions, then we slow down the economy. And then the response of the government is going to be probably like the responses that we've seen otherwise, where it'll be heavily stimulus laden and there'll be additional regulatory and controls on other things. That's what I think if I were to spin out a 10-year scenario would look like.
Hmm.
I don't know. I'm interested, but I don't know.
So,
I
like what we keep on seeing, right, is this whole narrative of that the AI bubble is starting to burst, and maybe there's some clues somewhere here and there. But what is actually happening? Because, um, I do enjoy the AI innovation train, but I also enjoy the pushback that we're seeing in this market from
yeah.
Mr. Wonderful not being able to build his data center in Utah to companies pulling back on AI spending to, watching OpenAI squirm. It's actually kind of entertaining in its own right, but like, at the point where maybe I get to there until, we start losing jobs and people start losing houses, that I think, is something that is really curious for
Yeah.
me.
And that's not, we have to, when we lose confidence in the market, we lose a lot of bad things happen. And so
Yeah.
when liquidity, our biggest fear is a dry up of liquidity because of it's tied up in a lot of things that don't pay off very
And
easily. And
that's kind
so,
of it right now, right?
right,
With all this,
right,
the hyperscalers and everything, and it's earnings
right,
season. And we
right.
saw what
So,
happened with IBM yesterday, right? It cratered 24% in 20 minutes.
Oh, but see, that's not the thing. So at the end of the day, I'm not even worried about IBM, and
Yeah.
I'm not worried about any of these companies in their cash flow projections or their battle reserves. I'm worried about, so it's going to be interesting. I'm worried about the unwinding of the market for the small and middle-sized players when investors get nervous. And it could be triggered by something that happens at Amazon. It could be something that's triggered by a company no one's heard of in this way. Something happens, the company does X, people get nervous, institutions, things like pensions start saying, I got to pull out our money from exposure in private credit and private equity markets. You get a whole bunch of redemptions. The providers of this are like, look, we don't unwind like this because we haven't seen a market. Private credit and private equity the last 20 years have just exploded in size. They're gigantic, gigantic, like trillions by magnitudes now, trillions of dollars in size. And we've never had a market this size. They don't know what a downside looks like for a market this size. And so people have a lot of irrational exuberance on this that I take with some caution because we've seen that when people get worried about their financial situation, they tend to hold their money, they pull it back. And that means that markets break. Markets break when people put things out there. There's liquidity, there's redemptions, there's buyers and there's sellers. If one side of that market departs, you don't have a market anymore. And then that collapse in liquidity is always a fear in this space because a lot of it is there's no regulation that can adapt effectively to this to figure out a way around this. And that's a fascinating issue. Man, Colin, I just want to point out how Colin and Michael are just like they're flying. This is just
We
like
should
this.
just keep the chat open just to watch
I
them
think we
go.
should just let's just leave. Should we leave them? Should we just let's do it? Let's
But
that's
Dr. White, I think I don't
I'm almost
were
done.
you able
I'm
to
like,
react to my little theory
yeah.
of the hyperscalers and some of
No,
these
yeah,
industry
okay.
vendors lobbying for a place in the National Defense Authorization Act just so they can be quote unquote soft bailed out?
I know. I tactfully tried to dodge the question directly, but I
Yeah.
think, and I tried two different ways of dodging. And you're right. I'm glad your follow through is excellent, Albert. And I
Well, if
appreciate
it's a
this.
politically incorrect question, I
No,
promise it's not
no,
going to
it's not a
cost you your
politically incorrect
job.
question. It's true. I mean, companies will always. So my thesis on this is too, right? So you can't have your cake and you can't eat it. You can't have your cake and eat it too. Like you can't say, I want the free market for all these things and then suddenly ask for things later down the line. Now, there's certain
Yeah.
instances where that has to work. So for instances, banks are a little bit of a different space because that's mom and pop stuff. That's serious stuff. And
Yeah.
I'm actually a pro. This is interesting. I'm not against bailouts. In fact, the TARP, the Troubled Asset Relief Program we had in 2008, was a way that we were paid back. The government actually made money by giving banks money. They gave it in the form they received preferred stock. Banks bought that preferred stock back. There were some failures, of course, but there were a lot of companies that survived because of that injection of capital. So it's needed, and that outcome is infinitely better. Like I'm
Are
Keynesian all the
Google,
way.
Meta, Microsoft, and Amazon too big to fail, like Bank of
But there's
America?
the point, right? These companies are huge, Albert. They're
Yeah.
huge. So if they were written into some way where the defense architecture was this way, that would be such a, so this is interesting. So it's different than saving your mom and pop bank in 2008. It's different than the
Yeah.
structure of other types of bailouts that we'd perform. This is saying in this case, we're going to write you into an act. We're going to write you into guaranteed business. When you do that, you're creating a recipe for the companies to operate inefficiently in this
Moral
different space.
hazards, right? As we
You're moral
discovered in
hazards. You're creating
'08.
moral
Yeah.
hazards. You could do something where you give them preferred stock in the same way, and they have to pay that off if they want to get rid of you as a preferred stockholder. There are other ways to do it without writing it into an act. I'm not saying they're absolutely going to try, to your point, Albert, and depending on whatever administration's in power at that time, they're going to try everything to get all the
We're gonna get a
everything
third
started.
Wall Street Oliver
Yeah,
Stone movie called, I don't know,
no,
Wall
but
Street 3, the AI never sleeps,
but there's the point. The point is
Yeah.
everybody's invested in this. It isn't just it's
Yeah,
just
that's
not
the
just
thing where it's just
yeah.
like, I mean, if Meta failed, I think people would actually be happier because it's one less distraction in our life. Sell it off for parts, for what it is.
Yeah,
But like Amazon's ubiquitous, Microsoft is kind of ubiquitous in some way.
but
Google is
My Facebook memories, Albert. Are you saying that
uh,
it was all for nothing?
is
Are
all
you
for
saying
all those trip photos you take. Yeah. Um, but yeah, I mean, I guess, yeah, it wouldn't surprise me
like
either if they went and asked for this bailout and that bailout happened in that way.
no,
Because, right, like,
no,
the
yeah,
Dow's at 52K today. Let's say it fell, 20,000 points in a month and a half. I think that depending on who's in office, right, the Secretary of Treasury is going to be out at the White House every day on his knees begging for, some kind of cash infusion from Congress.
Yeah.
Yeah.
I everything is possible, and that's why there should be distance between private firms and the government as much as we can make it
Yeah.
happen. Period. But do I think there will be? No. I think they're going to try everything to get those
And I
bailouts.
think a lot of people are going to take joy
Yeah.
from this crash because they're going to be like, well, at least for maybe the time being, my job and my career will be safe because
Yeah.
tokens now cost more than it
Oh,
takes to hire me and use me for, labor. Because like I think one thing I think we haven't mentioned yet is all these companies are laying off people and saying, "Oh, it's because of AI being able to do their job." But what they're not saying is they overshot their shot, and now they're rehiring some of these people very, very quietly so
yeah.
they don't have egg on their face. And I'm actually curious to know, like, would that show up in the job numbers somewhere? Like, could we see that or no?
It would be tough. It would be tough to gauge nominally. I think because they're survey driven, it depends on who you ask. Yeah, that's the hard
Yeah.
part.
Don't we have like record low labor participation right now?
We do. Oh my
So
gosh.
I guess like, over the years we should be our economists, I guess, tracking the rise of AI
They
impacting
are.
workforce.
And and so participation is interesting. And like that paper that they shot out in April that from all the main players and their uncle and favorite cousin, we had like 10 people sign on to this thing that looked at the effects of AI. I mean, tentatively, we do anticipate a negative effect to participation rates based on AI. But the point is what other jobs with technological achievement will be created through this? What other means in this? I'm not, what does it look like? What kind of things are we developing? Will there be a whole rapport? Is there a whole sub-industry in the medical industry for the AI doctor and its support of human interaction and engagement and relationships and sales and all this other stuff? So there's a lot of unknowns. I will point it though, their thesis was it would affect negatively about 10 million jobs by 2050, which might be an underestimate, maybe it's an overestimate, but they say nothing or don't have enough information, I should say, to say what jobs might be created as a result of it.
Why aren't we at like a 4-day work week yet?
Hmm.
As a
It's
result of all
hilarious.
Because
this
And I don't know if you saw
unleashed
that.
productivity.
I know Colin saw it, but Dr. White, it's hilarious. I got a 996 job listing this week in my email, and I posted it to my group, and I don't know if you saw it, but basically they're asking for 6 days a week where you start work on Sunday, and I think you do Sunday to Friday, with I think 5 days in the office and 1 day remotely. And they claim that I guess they pay higher than the industry average or whatever. And my whole thing I was thinking was, if you're gonna require me in the office for an additional 7 weeks a year, because that's what it comes out to on a yearly basis, are you gonna
yeah.
pay me for the extra 7 weeks, or is this gonna be the same thing as, originally? And to me, I think that is just a sign of the AI, I guess, desperation, where it's like we're gonna just have you in the office for 6 days, maybe 7 days, all days of the week because we want to make this work so badly. And Colin's assessment of it was, I guess he's been reached out for this job before, and this company has been trying to hire people for a while now, and other people in my group have also gotten this job and they've passed on it because it's such an abuse of their time, energy, and money. I don't know, Colin, did you want to say something about that opportunity too? Since, my joke was AI was supposed to give us a 4-day work week, but instead we're working 6 days and 6 days.
I I mean, I made a joke a while back that if companies really wanted AI to work,
Yeah.
they should just tell us, hey, 4-day work week starts now, but you have 3 months to make AI work. And if it doesn't work, we go back to five. I guarantee you the industry will make it work so fast. Like
But I,
they're not
I
thinking
I
of the
think
right
that as much as
incentives.
they would want to make it work, it still
Yeah.
wouldn't work
Like
because
if you told me, hey, your job is now 4 days a week, just make sure this agent AI starts working in 3 months. I will work overtime to make sure that happens so I can keep the 4-day week thing going. Right.
yeah.
Like that the incentive there is absolutely front loaded. And then there's like, yeah, after 12 weeks, if you don't get it to work, we're back to 5 days a week. So sad. I
I'm
don't
telling you,
know.
I can't be more proud to be a tenured academic than when I hear the word 996 and to have that
Oh
word.
man, the I'm not
That's
allowed. I signed an NDA where I'm not allowed to disparage them, but I'm allowed to say that one of the reasons I left my old company was they wanted me to 996, and I was like, but why?
there's I people must live the life that feels most meaningful to them, but I encourage you to live your life as if you have just one. And to
There
do
is
it.
only one. Yeah,
Yeah. And so I would mix it with if your passion and your joy is work, then work. But if your passion and joy is not work, I would find a way to work and optimize your life structure more effectively. I hope that doesn't spread. 12, 12, 7. Thanks, Aaron. Yeah, let's go around 24 hours a day, 12 a.m. to 12 p.m. Never sleep. Let's get this. The chat
Yeah.
GPT.
Yeah, I mean,
Doctor.
I'm curious, Dr. White, given has there been any 996 research in your field yet where you
No,
talk about the
great question. I
economics
can take a look at it. Didn't they treat
yeah,
it in 996 and kind of, didn't
of
they
a
partially make it illegal back a few years back? Didn't they like talk about this as a sense? I know it
you
originated in.
you get marginal productivity gains on a 72-hour work week versus a 40-hour work week. Is
Logically,
Henry Ford
yeah,
rolling in his grave?
I know. Well, the point is that's sort of the point too. You might ask yourself too, but one thing we've been really bad at in the United States is adjusting our working hours based on productivity. So that there's a lot of research about
Oh,
that.
I mean, there's
About
that, right? Where our
yeah,
productivity has gone up immensely, but wages have
yeah,
not, among
yeah.
other things. We could
So
talk
there's a
about
lot of
that until we're
research.
blue in the face too.
So I
But
don't
anyway,
know.
yeah.
The economies of scale here. I mean, it's an interesting thing, but it's terrible for people to be pressured in that way. Two quick notes. I just want to point out, those of you interested in reducing the federal budget deficit, Aaron sent around this tool to me for you guys. You can actually develop your own federal budget challenge to help get rid of some of the deficit, of course, since we're paying 14% of our government expenditures on interest payments to service our national debt. You can figure out a way to balance the budget. And so that's your homework for next month is to balance it effectively. Looking locally at San Francisco and San Jose, two things to point out about these slides. Unemployment, the physical number of unemployed people are down, but the amount of people who left the workforce is down more. So
In the Bay
we're seeing
Area
a lot of,
too?
yeah, in the Bay Area, we saw civilian labor force between April and May drop 15,000 in San Francisco and drop 4,000 in San Jose Sunnyvale.
Does that
And
mean that people are leaving the employment roles or are they just giving up altogether?
are they leaving the Bay Area or just leaving employment? But the
Anyone
workforce
on here,
shrunk.
out of the folks who are here today, would care to explain your behavior?
I know.
You
Why are
can
you
speak for
leaving?
all of them.
And don't say housing prices. Anyway,
Yeah.
you can also connect with me. Chung says, when robots become popular, we don't need the 996. That's right.
Oh
I
my
have to, but
God.
you have to go to work with your robot 12 hours a day for 6 days a week. That's the problem. So
Crazy, crazy.
I have to go to work. I have to
All right.
monitor my robot.
So, our next webinar after this is August the 20th. That's a month and 5 days from now. Anything to pay attention to? Thoughts for job seekers,
Right.
Dr. White?
Number one thing, thank you guys, of course, for having me, of course. But number one thing, of course, take a look at that headline jobs number. See what gas prices do in the next month as well. Those inflation things. The longer inflation lasts, the more negative effects it has. So if we re-embark upon more of a bombing scheme with Iran, and it seems like petroleum markets are extra bummed out about that with higher prices, take a look for that in next month's print of the CPI, and that might slow down this decline we've seen quite a bit, or even might even potentially reverse it. Jobs numbers, we got to do better than 57,000 if we want to see this in the future. Very curious. This series of firms doing well was so random this month. I have no idea what to expect. And take a look and see if leisure and hospitality bounces back next month, or we're seeing 2 months might make a trend. Take a look at this. And for job seekers in general, please welcome, please remember, upskill, reskill, do all the things, manage AI and AI well, and don't lose hope. There are places around the country that are hiring, even if this area isn't. And so always continue to build network and build, take a look at the skills you have and what your weaknesses are. And I would say one of the things that's helped me and entered into roles that have helped me a lot is focusing on the weaknesses I have, benefiting and bolstering those with different things and making myself ultimately more marketable. Take risks, make mistakes, take challenges, upskill. Bam. And listen to Colin and Albert.
I mean, we might have an interest rate hike, if the inflation thing keeps going up. So we'll
We
see.
might, but that's going to be so hard to do. Interest rate hikes for the Fed. The poly market, I think, is trading at like a 95% no change for next month. But we've got right now, if we look 2 months, 3 months down the line, it would have to be driven by not just oil shocks because it is going to be interesting. Michael, everybody buys XOXO, please. I can't, I don't think I'm allowed to endorse individual securities,
Not
but
not financial information. Yeah, no, I mean yeah, that I mean, like I feel like we all should have listened to Aaron 3 years, 4 years ago, just do what Paul Volcker did and just raise interest rates to 20% for 2 months and then let everything shake out and then, just lower it back down. Um, but armchair economics, right? Cool. Colin, do you have any final thoughts before I conclude? I think Dr. White has given his.
No, I mean, everyone, please stay safe, stay healthy, consistently improve yourself and learn about what's going on. And hope if you don't have a job, I hope you get one. If you have a job, I hope you manage to get something better too.
Well, the quit rate is, I think, lower than ever. So I don't know about that part, right, Dr. White?
I mean,
I know
the
people
best
are
way to get
nervous
more
out there in the
money,
job market right now. If you don't like it, people are like, no, no, don't quit. I've got my seniority.
the
Make
best way to get money is to jump.
that is true.
It
Also
is true.
true. Best way to get money is to jump, but also
Yeah.
people are value,
Every time I found a new job, it was like another 10 to 20% bump. I was like, okay.
Yep. All right. Well, cool, everybody. Next month's webinar is here in the chat. I want to thank everyone for joining us today. We've got so much more coming up on the calendar here, but feel free to join us next month as well as we keep going through these numbers and trends. And as always, don't forget your questions. We'll chat with you soon. Goodbye, everybody.
Thanks, guys. Thank you so much for coming.